This chart shows a Bitcoin market boxed in by opposing liquidity pools. Current price action is contained between two dense yellow bands of high leverage, near 64,500 and 62,800. These levels function as dynamic traps, built of trader leverage, waiting to be sprung. Short-term cryptocurrency price action is rarely driven by fundamental news cycles. Instead, the market operates as a mechanical hunt for aggregate leverage. To expose this hidden algorithmic activity, we use a specific analytical tool, the liquidation heat map. By tracing a continuous 5-day window on this map, we can empirically prove how the market builds, targets, and aggressively absorbs these leverage zones. This visualization translates raw order book data and leverage multipliers into a visual gradient. When traders open 50x or 100x positions, their liquidation prices aggregate and map onto a color scale. The y-axis tracks exact future price levels where forced liquidations will trigger. Bright yellow represents the maximum density of estimated triggers, the dollar value of positions forcibly closed if price hits that level. The mechanics of a forced closure are absolute. Liquidating a short position triggers an automatic market buy order, while liquidating a long forces an automatic market sell. This clustered density creates a magnetic zone. Institutional market makers are incentivized to push price into these clusters to guarantee their own liquidity. Understanding this specific visual grammar is the prerequisite for reading the future roadmap of short-term market volatility. On July 3rd, the market established a clear baseline. We can see high-density liquidity pools forming beneath the market price at 60,800 and 61,500. Hours later, the map reveals a thick band of late-long positions forming below the current price, reinforcing parallel lines at 60,800 and 61,800. This dense lower leverage creates our baseline risk environment, a known quantity of sell-side liquidity waiting to trigger. Shifting to the upper board, price begins an upward expansion away from baseline support, testing 63,000 resistance as it approaches the upper yellow clusters. Observe the behavior here. As it nears upper resistance, it acts magnetically, drawn directly toward the liquidation density. This massive safety net of lower liquidity allows algorithmic actors to comfortably push the market upward to hunt trapped short sellers first. Through July 4th, the upward price expansion identifies three specific horizontal bands, near 62,000 and 63,000 as the primary targets. The upward hunt climaxes July 5th. Price accelerates directly into the thickest concentration of short liquidations between 62,000 and 64,500. As price pierces these yellow bands, short sellers are forcibly liquidated, triggering cascading automatic buy orders. This forced buying provides the precise automated liquidity that large entities require to offload their own long exposure without moving the market against themselves. The aftermath is clearly visible on the heat map. The immediate zone above current price action, which was dense moments ago, is now dark purple empty space. The local upper liquidity has been fully absorbed. Once a zone turns purple, the magnet is turned off. This neutralizes upward momentum, as there is no longer forced buy-side liquidity to sell into. With the upper liquidity pools depleted, the hunting algorithm must recalibrate and seek out the next highest concentration of leverage. By July 6th, the market state has shifted. While distant upper targets remain, a heavy, immediate concentration of yellow bands has formed directly below current price action. The path of least resistance has flipped to the downside. Resale traders, emboldened by the move up, aggressively stack late-long positions here, inadvertently constructing the next algorithmic target. The result is a violent downward cascade into July 8th. Price locks onto the newly formed lower bands, trending sharply toward the density at 61,800. The drop is surgically precise. It ignores standard fundamental support levels and targets the exact liquidation math forming at 61,500. At the climactic moment, the price wick pierces the bottom yellow band. Long liquidations are absorbed, and the zone acts as an algorithmic floor. This final flush forces market selling, providing liquidity for institutions to cover shorts and re-enter long positions. This perfectly executed reversal confirms the cyclical, engineered nature of leverage extraction. Reviewing the entire 5-day sequence in rapid succession reveals a continuous feedback loop. Retail traders utilizing extreme leverage inadvertently construct a highly visible roadmap of vulnerabilities. Institutional algorithms do not need to predict the news. They simply execute against this mathematically defined roadmap. This creates a psychological trap where traders mistake these algorithmic liquidity hunts for fundamental breakouts or breakdowns. Surviving this trading environment requires abandoning traditional indicators in favor of mapping the actual mechanics of forced liquidity. This chart contrasts the predictive power of the liquidation heat map against traditional lagging indicators like a volume profile. Traditional volume only shows where trading has occurred in the past. Liquidation heat maps show where forced, price-agnostic trading must occur in the future. The actionable takeaway is to stop guessing market direction and start identifying the heaviest concentrations of liquidation leverage. By treating these liquidity pools as magnetic targets, analysts can reliably identify high-conviction zones for mean reversion or structural breakout strategies.